Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Hello, everybody. Welcome back to the Emerging Managers Podcast. I'm your host, Scott Kelly, and thank you again for joining us. I had a great opportunity to introduce a new friend and a partner of mine, Pablo Grodnitzky of Plus Ultra Capital Partners. And, he brings vast experience to not only investing in companies, but growing portfolios. He's a venture capitalist, an SPV fund manager, and a growth strategist with 28 years of experience scaling technology companies to well over 100 million AR. As a founder of Plus Ultra, he specializes in late seed and Series A investments, structuring SPVs. We've heard that term several times over the last several weeks, that align institutional LPs, family offices, and high net worth investors with high growth opportunities. He's a Silicon Valley veteran with expertise in scaling, go-to-market strategy, and international expansion, actively raising and managing multiple SPVs for high-growth technology startups with a hands-on, friendly approach, which is a trend that we've seen quite a bit over the course of the podcast interviews that we've done. So what I'd like you to do is listen in, get some great advice, find out what he's investing in and how he's helping portfolio managers succeed and how investors are maximizing the returns. Give it a listen. Hello, everybody. My name is Scott Kelly, the founder and CEO of Black Dog Venture Partners and your host for the Emerging Managers Podcast. And I'm excited to introduce all of you to Pablo Grodnitzky, the managing partner of Plus Ultra Capital Partners. Pablo, welcome to the show.
Thanks, Scott. I really appreciate the invitation.
My pleasure. So before we get into what you do at Plus Ultra, share a bit about your background prior to starting the fund.
I'm an immigrant from Argentina originally. I grew up in New York, been out in California for a long time after college. And I had a long sales and marketing career. I started out in product management, then went to business school, and from business school went straight into sales. Like a lot of people who graduate business school, you thought you'd do that on the way to like being a CEO or something, but instead I was good at it. And so I stayed in it for about 25 years, coming up through the ranks and ending up a CRO and an SVP of sales at different size companies. I did about half of that time at large companies like Nuance Communications and IBM, and about 13, 14 years of startups as well, everything from pre-revenue and then taking companies from 2 to 10, 25 to 60, 30 to 80, those kinds of experiences with the small and developing teams. And then at the larger companies in the latter half, I was running a few hundred people at IBM. IBM always has scale, right? I had 350 who are accountable to me. So I came up through sales and I realized that those skills could be quite useful from an investment point of view, because you'll see when we talk about our thesis, we are very focused in on go-to-market and actually investing in companies when they're transitioning from being about the promise to being about evidence of success as opposed to something more visionary.
Well, let's jump into the thesis. Share a bit about your fund, what type of industries you invest in, what stages, and then, other attributes of the folks that you're investing in.
Sure. Plus Ultra Capital Partners is a late seed and Series A investor.
Okay.
Late seed to us is checks of $2 to $5 million. Series A's are 10 to 25, 10 plus. We are stage specific and reasonably technology agnostic, right? So we are looking for product market fit that is not the traditional Silicon Valley feels and vibes version of product market fit. Our definition of product market fit is 68 metrics and 11 categories. And we've developed our own AI system to kind of suck in a whole data room and tell us if someone's got it or not, kind of thing, right?
Okay.
And all the investment partners here are a little bit, are like me. We've got substantial careers in go-to-market before we became investors. So we got CMOs, chief product officers, CEOs as well. And we bring that experience into making investment decisions. I mentioned being stage specific. The reason that we chose starting at product market fit is because only 15% of companies right now, and for the last few years, have been raising Series A's, and 42% of seed rounds are secondary and tertiary seed rounds. So what we see is that there are a lot of companies getting to around product market fit who then can't build a repeatable or scalable go-to-market model that'll accelerate them through Series A. And the numbers kind of back us up. And we bring that experience to the table. we are also a full spectrum VC, and we designed ourselves to be. So one of my partners was at Bain doing due diligence for private equity funds for 15 years, that kind of thing, right? And we do due diligence because we want to lead rounds, and we want to lead rounds because we want to take a board seat. And we want to take a board seat because we want to put our finger on the scale of go-to-market execution once we're there, right? So we like to think we bring capital and expertise as opposed to just capital or bringing advice as you could get from fractionals and that kind of thing. We act at the board level, we act as a diagnostician, medical terms, as to what the challenges are. And then we bring specialists that hopefully, some of the capital we brought in will fund to kind of fix the go-to-market issues that will help people accelerate.
You mentioned these, I think it was 68 indicators. Talk about some of the top indicators that you use to make a decision to invest in an entrepreneur and an early stage company.
Some of them are the traditional ones. So you expect CAC and CAC LTV ratios, ARR and growth ARR. Some of them are very traditional, right? But there are softer ones. We use the famous Sean Ellis test because people live without this after they try it as well. It is a metric we're looking for. Number of customers, have they sold the same thing 10 times, right? I mean, is it a repeatable model kind of thing, right? As opposed to a consultancy with tools, right? You go through a whole list like that. Have they sold anything without a founder involved kind of thing, right? No one is definitive. I'm sorry, there are some that are definitive, right? I mean, if you've got, we have invested in companies with under $1 million in sales, though that is the traditional kind of target, right? We never invested in companies with 100,000 or never in zero and never with substantially close to that, because we look at it as if you could triple your sales next year and still be under $1 million, it's probably not a good fit for us because we are looking to invest capital in growth.
Talk about industries. What are the industries that you're investing in most? Maybe share some you're staying away from, or maybe talk a little bit about, where you are investing from a vertical standpoint.
I mentioned we were agnostic, so you'd be surprised. I mean, we've looked at small nuclear reactor companies and medical devices companies, and of course, lots of AI software. There is stuff that is trendy that we're a little. Everyone needs an agentic version of something, and this is not a criticism because some of them are good, but we probably look at 2 agentic HR candidate sourcing apps a month, kind of thing.
Wow.
Right? There's just a lot of them out there. So we're looking for are things that have sufficient SOM and SAM, right? That we could help accelerate, right? And so we're not necessarily always looking for the sexy thing. We're not trying to be in competition with a steal one from Sequoia or Andreessen Horowitz or those guys, right? We think there's a huge market of people who've got good, solid, very interesting businesses that with some execution, with some internationalization, with a whole bunch of things, we can actually bring very positive results. And that with us being at the board level and helping with go-to-market, we are working really hard to have better outcomes than the typical traditional saw of everyone needs unicorns because only 10% of your companies deliver on the VC promise.
You mentioned, obviously, you started out, you're living in Argentina, New York, California. Do you have a geographic focus, or where are you from that standpoint?
We really don't. One of my partners is Israeli, another's Korean. 2 of them are from India. We're all people who've been here a really long time, but we have a really international, the entire investment committee here is international. So we kind of do well with international companies. I would say that we do take a U.S.-based approach to it. We expect ambitious goals, and we feel great when they have complex models of sales because we can help with those kind of things, right? And strong internationalization bents we also feel we're good at. So, we've passed on companies we liked and they liked us, but their big ambition was to go from Germany to Austria to Switzerland. And to us, that's like one market with 3 borders kind of thing.
Right.
So, we're not looking for someone who's trying to build a local powerhouse. We're looking for someone interested in building a global company.
Build scale. Absolutely. So, maybe you could share, to the extent you're able to, some success stories, some of the portcos that have done really well, and some of the companies that you're excited about that you're currently invested in.
So we've invested in all kinds of things. So medical pharmacy for mental health things. We are a fundless fund. We go to market through special purpose vehicles, SPVs. We build a fund for every company. And that way we play in a two-sided market. We like to say, we find, we filter, we fuel, right? We fix, and then we flip kind of thing, right? And so the idea is that we get them through a stage. We've done eight of them. The ones we're excited about now, again, very varied. There's a lithium extraction company. It's much more than a wallet. It's a document, a secure document management company that will help people get through airports and financial institutions and all that kind of stuff, where you've got highly secure documents in a mobile way kind of thing, right? So imagine if you could have your passport. Everyone keeps their passport hidden away for the day they need it. If you could have it with you all the time. What else? Several medical devices companies doing really innovative surgical stuff. So, and again, small nuclear reactors. There is one international agentic HR company that we are very close to starting with. Again, what really comes out is that we're looking for a stage because in the end, if it involves a partner ecosystem, if it involves developing on the ground sales force or some combination of both and how to balance those kind of thing, right? Anything that can benefit from go to market expertise, we're interested. Right. We stay away from the ones where we can't help, right? We can't help someone if they've got years of tech debt to overcome. They should be working with someone else at that point.
Sure.
Because they're not going to be growing there, or they're going to be trying to grow while the product is a wreck and trying to fix it. They're literally trying to change the engine on the plane, right?
Right.
We know we have to do that sometimes as well, but we're more comfortable doing it on go-to-market issues kind of stuff, right? No, your SDR system, isn't working anymore.
Okay.
It needs to be changed. Right.
So you mentioned obviously your SPV strategy. Maybe share a bit about the makeup of who your SPVs are and who would be ideal SPVs, LPs, or investors to join your network.
Yeah, it also depends on the size, right? Because we deal in that 2 to 5 market versus the 10 plus. I would say that our largest our largest members of SPVs on the smaller side is always angels, high net worth individuals, often ex-tech execs or ex-founders who've exited well, right? When they get a little bit bigger, we're highly involved with family offices, single and multiples. We haven't done a lot of small institutional, not because they're not interested in our approach or from a technology like this AI system that I mentioned. It's just because they take so long. They're really more used to writing a big check to a fund, right, and then getting their reports than investing in SPVs. We are the opposite of your typical company in that, to us, investing in a traditional fund is like investing in a mutual fund. You write somebody a big check, they invest in about 20 to 30 things, right? And you come back 10 years later, see how you did, kind of thing, right? We're at the opposite end of that kind of diversification. And with an SPV, you're investing in the stock, not the mutual fund, right? You're investing in the company. And in our process, I would say over half of the LPs absolutely want to meet the founders at some point, even in a brief conversation, to know what they're investing in.
So it's a far more proactive approach to making the investment as opposed to just, picking a manager, so to speak.
Absolutely. And we found that it's got this particular benefit that we just call smart capital, right? You don't bother them a lot, but if ever your company runs into a speed bump, people invest in stuff they know, right? So a cyber investor isn't going to invest in a women's apparel e-commerce thing necessarily, kind of, right? You get people who know this or something about this business or enthusiastic about it. If that business ever hits a speed bump or some issue, you write an email, you get enthusiastic response, right? And how they can help, because a lot of them want to be close to the company because they think they can help. And that's fantastic. There's some great synergies in that.
So for potential investors listening to the podcast right now, why plus Ultra Capital? Why now?
Great. So why plus Ultra Capital? Because we take a very disciplined approach to driving execution, right? You're investing in an SPV. That means you have stock directly in the company and you have us as your agent in the company, right? Managing what we hopefully all agree is the most important thing that can happen at that company, which is revenue growth, right? And you can see from the experience of the partners and our active participation on the board, we are not a passive investor. We're not putting chips down on companies. We're investing in things that we can influence to come out with a great outcome. So we're looking for great companies that we can grow We're not looking for unicorns because we've got to hope. We've got to hope that something turns into a unicorn. There've been over 12,000 unicorns. Everyone can get one, kind of thing. So, but the issue is to better your outcome from about 10% hit rate at some level, right? We take the active management approach. We're a VC, but our closest cousin would be a growth private equity firm, right? We take an much more active approach. That's why we lead. We rarely follow on or take an allocation in someone else's deal because we think our value add is being there on the board to help that CEO and other board members with the go-to-market issues, right? That's why that kind of direct impact for investors who want to invest directly, we are your agent there. And then, of course, we do the kinds of updates and regular LP relationship management that makes people comfortable with their updates. That's not just a report that says at the end of the year, this is what you put in, this is what you got. You'll get regular quarterly reports on the companies you invested in, with the highlights and lowlights and challenges that are going on, kind of thing, right? So we take an active management approach, and we are your agent in your investments. That's great for the people who want that, and there's a good market for that. There are still plenty of people who want to invest at the other side. I mean, funds of funds are doing very well to their credit, right? Well, imagine if you invest in a fund of fund, they typically have a 1 in 10 management fee and carry to add to the 2 in 20 that every VC will have, kind of thing, right? So at that point, you really want diversification, and you're willing to pay a lot for it. The last thing is that SPVs are also much more efficient, right? Our fees are substantially less than your typical 2 in 20, right? I mean, at 2 in 20, 20% of your money is out, effectively on day one, for fees, and another. Basically any company. A classic VC can invest 2% of their fund as an average investment. We can be fundless and as we've got several $15 million, $20 million deals, right? For us, it's the ability. Do we believe that this will generate enough LP interest from sophisticated, accredited investors to fund this?
Any final thoughts that you'd like to share with the listeners today?
I urge people to really look at SPVs in a different way. Half the market of SPVs is still $1 million or under, right? You get to 2.5, which is the kind of the bottom we do, and I think that's 75% of the market. We specifically go at the higher end because we believe that this is a new category of investing where people, sophisticated people, can invest in sophisticated investments, and we're bringing the kind of managerial transparency and expertise to it, so you can have superior outcomes, right, to hoping that 10% of your investment turns into unicorns that will drive outsized returns for you, right? I think people got used to the idea of SPVs being a kind of sidecar for a VC that do a little bridge thing, right? So everyone knows there have been $100 million SPVs and lots of $40, $50, $60 million SPVs out there, right? It is also a tool, and in real estate, there have been $1 billion SPVs.
True.
But it is a tool for sophisticated investors, and we think we're on the front end of what is an emerging category of helping people directly invest in companies and managing the outcomes.
Fantastic. Pablo, where can people learn more about Plus Ultra Capital Partners and get in contact with you?
Our website's a great place to start. We've got a lot of information on both for both LPs and for founders, right? With a lot of materials on both how we invest, the kind of tools that we use, the kind of reports they'll get, all that kind of stuff from an LP side. And from the founders, we take a very karmic approach to this, right? We put good stuff out there, and we hope that someday, somehow, from somewhere, something good happens. So when founders deal with us, even if they're not the right fit now, we send them a curated list of emerging early stage investors that we've got. And I've got coming out of sales, we have a how to do a 90-second pitch deck, which people find very helpful, kind of thing, right? We've got a whole bunch of tools like that. So start at our website, and I'm always available at PabloPlusUltra.com. Sorry, did I say .com? PlusUltra.capital. The .com came out too early. PabloPlusUltra.capital. Sorry about that.
And the website's PlusUltra.capital. So
that's right.
Pablo, thank you for being on the show. For those listening today, make sure you follow up with Pablo on his website, and obviously follow him on social and reach out to him. If you're an investor looking to diversify your venture capital portfolio of SPVs, or your founder, looking for that investment plus opportunity. Make sure everyone like, comment, share this podcast. And Pablo, thanks for being on the show today.
Scott, thanks so much for the invitation.
Thank you. Well, I'm glad we got a chance to interview Pablo today because he really gave some great insight on how to actively manage a portfolio and actively help the portfolio companies. As I mentioned before, he's using this SPV approach, the special purpose vehicles, where he's allowing his co-investors to invest directly in the portfolio companies as opposed to the venture capital structure. And as he discussed, he's using his active management expertise. He's not a passive investor nor his partners. They have substantial go-to-market experience actively participating on the boards of these companies to drive revenue growth and improve outcomes. In addition, he has a very disciplined due diligence, which I'm finding is really the thing that makes these emerging managers more valuable. He uses an AI system and a rigorous 68 metric framework to identify companies with proven product market fit rather than relying on unicorn hopes. This model with SPVs allows much lower fees for investors, and where you can get a significant portion of your capital can be eaten alive, as opposed to being that money going into helping the company and helping your returns. And the great thing also is he provides transparency. These partners are going to invest in SPV. They want to know what's going on. And he's providing investors regular quarterly updates. And they engage with founders and fostering a smart capital environment where LPs can offer support, not just capital, when these portfolio companies need it. And so this is a trend that we've had over the last several months of the podcast. And as you're going to find in our future podcasts, that trend's going to continue. And so what I want you to do is continue to follow us. I appreciate the support. Go to Emerging Managers Podcast. Follow us on all the streaming channels. We've got more great interviews coming with more emerging managers. Thanks for listening in.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.